Imagine a professional trader sharing the strategic steps behind a high-precision index futures trade. You'll discover how to identify the weekly market bias, spot those liquidity hunts, and execute using a pattern called a fair value gap. This is the key to achieving trading independence.
It all starts with a top-down analysis. First, you'll learn to determine the weekly market direction. Then, you'll pinpoint key liquidity levels and imbalances on the daily chart, which act like magnets for price.
When I say learn to start looking for where the market's going to draw to, it's drawing to one of two things, okay? It's drawing to stops, which is liquidity, or it's running to an imbalance. Now, what's that mean? Above old highs, buy stops. Below old lows, sell stops. Imbalances is something like this over here, where you have one single candle pass higher, and the previous candle's high is here, and the next candle's low is here. So it only went up one candle, nothing moved down to overlap with that same delivery on that price candle there. So in other words, that's an imbalance. It's only going higher and nothing else is here to offset that and efficiently deliver price on the opposite end.
Before a big move, algorithms tend to manipulate prices to build liquidity. Now, here's how a stop hunt works. It fakes a breakdown, then pushes prices up to trap traders just before the real drop.
The market's being driven higher, and the algorithms are going to attack that buy stop liquidity pool. Why would they want to do that? Number one, it's going to punish those individuals here that went short. When it drives above this high here, it sends all those buy stops into market orders, flooding the marketplace. That gives a huge influx of willing buyers at a high price, which is the perfect counterparty to smart money that wants to sell at a high price. Remember, the market wants to go down here. So when it drives up to here, those buy stops are the counterparty or the other side of a smart money trader that's wanting to go short. Because they're going to sell short, they got to sell it to somebody who wants to buy it at a high price. That's why the market does this.
This is the precise entry trigger. After the stop hunt, you look for a break in the market structure on a lower time frame. Then, you identify the fair value gap that forms, which sets you up for a high-precision short entry.
This type of move. But it runs the stops, then we have a short-term low, and then it breaks below it. So now we have a break in market structure. Okay? Once this low is broken, you're going to look for this little area here. That's that imbalance I mentioned in the beginning, right? So what's happening is the market's going to go right up inside that area there, and that's where you want to sell. Now, if you don't sell there, you can drop down to a lower time frame, 1 minute chart. If this was a 3 minute chart, you can go down to a 1 minute chart and look for that to occur on that time frame as well. And it many times will form if you're looking at a lower time frame, like say this was a 5 minute chart, and you looked at a 1 minute chart, you'd find one down in here. It's a matter of scaling down in your time frames, because once you have an underlying premise to the market now likely to go lower, it becomes an easy thing to look for these types of things. So in your chart, once you're developing this idea and learning it, you're going to highlight this candle's low, this candle's high, and this right here is what I teach my students as a fair value gap. Okay? You don't have those in books. Okay? You don't have any of that kind of stuff out there.
To complete the trade, establishing a target is crucial. You'll learn to use the liquidity matrix, selling in a premium market and targeting liquidity in a discount market, ensuring a logical, high-probability exit.
This here is your range. This is the low of the day, and this is the high of the day thus far. So if we take that range and split it from the low to the high to get the midpoint, all of this can be determined by a simple 50 level on a Fibonacci. So you drag your fib from this high down to that low or vice versa and have your 50 level highlighted. Then anything above that 50 level, this is referred to from an algorithmic stance as a premium market. It means it's expensive. Now, markets can stay in a premium for a while and not go to a discount, which would be below the 50 point. Okay, 50%, anything down here is a discount. If you're bearish, if you're ever going short, you want to look at the previous range. Where are you at inside that range? So when this formed here, that little fair value gap, once that formed, you're thinking, okay, we are in a premium, so algorithms will want to go to a discount. That's the opposing side of the marketplace.
By mastering this framework, which includes the top-down analysis, liquidity hunts, and fair value gap entries, you can build an independent and repeatable trading skill set that's truly empowering.